Yeah, I mean, one of the issues we read a lot about is the concern over potential oversupply. I mean, again, you're right there in the market. How do you respond to that notion?
There's no doubt there's a or a disconnect between a market perception of oversupply and actual reality. We are definitely expecting new stock to hit the CBD market in the next 12 to 18 months, which will no doubt adversely impact on yield and potential for capital growth in that market for a period of time. But pretty much the Melbourne market is characterised by an undersupply. We're in about 2.4% rental vacancy across Melbourne. We've been in that same position pretty much since 2005, and unless the banks suddenly released or changed their lending policies dramatically, which is unlikely to happen, significant new supply that will really imbalance the market is unlikely to come on.
Yeah, I must say I find it hard to accept this notion of oversupply when you look at the approvals numbers we looked at earlier, and you see a 30% drop in approvals in Victoria for apartments over the last couple of years. Suggests that it might be just the focus. There is so much focus on individual projects, and it's very high profile that gives the notion that there's more of them than perhaps there really are. Foreign investors too also attract a lot of attention and build the media profile. Tell us a bit about the involvement of foreign developers in the local market.
Well, in the last 24 months, they've been the most active section of the market, thank goodness. They've come into Melbourne. This is a slide that shows a number of development sites in the CBD. They tend to do the bigger scale projects. We're working for a number of clients at the moment in the CBD doing significant scaled projects. They recognise and understand that Melbourne has matured as an apartment market, that the demand for apartment living is growing consistently and rapidly upward from the local Melburnians. We've had strong international skilled migration growth over the last 3 or 4 years. That has started to slow, there's no doubt about that. But Melbourne was ranked recently in September of 2011 as the #1 most livable city in the world, which on a global city index of 140 different cities is a remarkable achievement. Our relative affordability on a global scale provides great opportunities for Malaysian, Singaporean, mainland Chinese developers to come into our market who have the great strategic advantage of being able to borrow offshore, where they're able to sell a larger portion of their product to foreign purchasers, which has created a great advantage to them. And the depth of demand for CBD stock between $350,000 and $600,000 is still remarkably strong.
Yeah, that's really interesting. It's a terrific insight that I think you can give to and bring to the panel today. Are there any particular hotspots you think for the year ahead in terms of locations or price points in the market that you might want to sort of focus on in the way of a summary?
Just going back to my first comments, 350 to 550,000 under 600k is really the depth of the market. As soon as you go over 600,000, your first home buyer's out. You know, the $20,000 incentives buying off the plan is a significant advantage to that particular buyer category. We recently launched a project in Northcote and had significant success with that. There's been 3 projects or 2 other projects that followed, so 3 in the course of last year that have all sold very well. It's an emerging apartment market. It's, I think, hasn't had a lot of quality projects over the last, say, 5 or 10 years, and location close to the city, great public transport, good city views and great lifestyle offering, but also making the local market affordable. And that's where apartments really work well, Kevin, is where the median house price, the apartments come in at about 50 to 60% of a median house price. So if you can get into a good existing freestanding home location and buy an apartment for about half of what you're expecting, the depth of demand and interest is significant. There's no doubt about that.
Okay, terrific. That's a great summary. Thanks, thanks, Andrew. Look, I think the panel's been a fantastic experiment this year. Please join me in thanking the panel this morning. Okay. All right. Thanks, guys. We're going to sort of finish up the presentation now by way of summary. Let me say it's going to be a tough year ahead, but we think the fundamentals of the Melbourne market continue to be in pretty good shape and should weather the storm pretty nicely through the next 12 months. We know the focus of the world's attention continues to be on Australia, and Melbourne is definitely part of the foreign interest, both on the development front and the investment front. So I'd now like to invite Tom Sutherland, our CEO and President for the Pacific region, to come up and close the presentation. Thanks, Tom.
Okay, morning. Thank you for coming, and in particular I'd like to thank all my colleagues for a huge amount of work that's gone into this presentation, particularly to the panel and to Kevin and Nick, but also to all the support staff who've helped. It really is a massive effort. I hope that you've enjoyed what we've presented to you today, and that you'll take out of this maybe a few thoughts about how we see the year progressing. I think it's very clear that the core sector of the market is reasonably predictable. Both Kevin and Nick highlighted how there's capital available for this side of the market. The leasing prospects are probably also reasonably stable in most of our capital cities. And for that reason, it's going to be very difficult to get set on core property. The supply of it is going to be very, very limited, and there will be a lot of competition. If you look at the secondary, tertiary, the market where the banks still hold considerable stock, some of the suburban markets, land, and some of the property that's still controlled by the private investment market, I think that's where opportunities are mostly going to sit. Unfortunately, this market is a minefield. It's a market where it's very hard to actually secure debt. It's particularly difficult from the point of view of predicting how you're going to get tenants, what sort of rates you're going to get, how you're going to pre-sell residential, etc. And it's a market where you really need good advice. And you won't be surprised to hear that that's an area that we think we can help you with. Our strategy for the last few years has been to move our business into new areas where we can provide solutions that don't just fit within traditional areas of real estate. We've developed a town planning division. We've got people doing project management. We've got people doing structured transactions, setting up strong JV arrangements with landowners. The residential side of the business you've just heard Andrew talk about. I think last year we sold in excess of 4,500 units off the plan. That's just in 2011. And we built these divisions to really be able to provide a much better solution and a much deeper analysis for people trying to navigate in markets outside of the core sectors. Not only have we worked in these areas, but we put a lot of money into our systems to enable outsourcing solutions and efficiencies in costs. The recent Stockland portfolio that we were awarded is really an evidence of how far we've progressed in this area. But it's not only systems that we've invested in, it's also we've got a massive database now of property around Australia covering every single angle and aspect of property. And that really does enable us to analyse and provide solutions in a way that traditionally was very difficult for us. So I think that we can assist you not only in the core sectors of the market, but probably in more difficult and complex areas. So I'd like to thank you for coming this morning. I hope that we can work with you during the year and help partner on some of the property opportunities that will exist. Thank you very much.